Hi everybody, it's Rhett Kessler speaking, and we're providing this update in these very unusual times. I've prepared a presentation. I'm going to address two things, maybe a few more, but predominantly two things. The first is what we think is happening, not from a macro perspective, but as it affects the portfolio, and with a few macro issues. And then secondly, we'll talk a lot about how we've positioned the portfolio and how we see things going forward. So I'm going to just, and also I'm operating remotely, so please excuse us if there are any technical snafus. So the first slide, I'm just going to the next slide. Okay, so apologies. Okay, so the first slide is really what I've been saying for some time, and our team's been saying, is that for some time share prices have decoupled from fundamental value, and I've tried to demonstrate where we feel as a market in total it's been very, very strong, and for some time we've been saying there's too much exuberance. As a result, we've built up cash. We've been very focused on price and defensive companies, and we've been a little bit left behind, as you would have known. As we move forward into the last few months, we got particularly worried, and we bought puts to protect ourselves. Now, this is a black swan event, as you all know. I'll tell you anything you don't know. And what we've seen is that not only sorry, I'm just struggling with the slides here, but not only does the market have to come back to what were original fundamentals, but it has to actually, original fundamentals have been adjusted down due to the post-COVID-19 outlook. So there's a lot of credit risk. There's a big interruption to consumer and corporate business or economic momentum, and so we've seen a real adjust down in the underlying fundamental value. Now, in addition to this, we're seeing that there are liquidity events or panic, what we call noise, but it's becoming a bit more real than noise, in that there now are concerns due to margin calls. We've had a couple of hedge funds blow up, etc. And in my view, in a number of stocks, we are now trading below fundamental value. From Anton and my perspective, this is refreshing, painful, but very refreshing, in that for the first time in a long time, we feel there's a lot of value on offer. We have a lot of cash. We have the protection of puts, but everything is being sold off indiscriminately due to the fact that FOMO has turned well and truly into fear. So that's a very brief summary of how we see things happening. I must stress that every single company so far, sorry, not every single company, many companies are withdrawing their guidance. Now, the implication of this is that not even the company management themselves can forecast earnings through this period. Certainly not over the next 6 to 12 months. So analysts are going to really struggle, and we think there's a lot of forecast risk inside this environment. Now, we remain focused on what we're calling, and I know toilet paper's got a bad name lately in Australia, but we are very, very focused on toilet paper and toothpaste type businesses. We're focused on good business models. We're focused on companies that will be able to survive through this because of the good management and the balance sheets. So if I go to the next page, how have we positioned the portfolio? So first of all, leading up to the market correction, our cash holdings increased to 18% in the lead up. We took significant profits in a number of companies that we felt were getting too expensive. These included stocks like Credit Corp. You'll remember we used to be a 9% shareholder in this company. We've sold significant amounts of our holding to the extent that we're only a 3% shareholder in the company now. JB Hi-Fi got really carried away. We took off a lot from that. CSL, ResMed, and a whole host of companies that we trimmed. We also persisted with accumulating the put options, and I fit there in red, even though it felt like we were tearing up money. We liked the fact that we had the insurance, but as we kept buying them, the market kept racing ahead, and we stuck to our discipline. Vols were ridiculously low, but we persisted. And then we've had a very careful selection of defensive stocks. Telstra, you'll see Evolution Mining there, which is, we don't think we can predict the gold price, but we think that's the lowest cost gold factory. And therefore that provided us with a hard asset, Viva Rhett, which is a landlord whose tenant is Coles in the petrol stations. It has 11 years of leases, long WALE leases, with 3% escalation, and we've got a significant position in Woolworths. We also have health insurers. We've got leasing companies that supply leases or salary packaging to the health sector, etc., etc. If we go to the next page, sorry, this is just a bit slow. So the big fall has arrived, a lot sharper than we would have expected, and a lot more vicious. And how are we approaching the sharp fall in the equity prices? Well, first of all, you can think that we're kind of like a sniper, sitting far back and using up our bullets, and I keep very, very selectively and keeping our powder dry. We've mainly added to existing holdings. Credit Corp, NIB, Telstra, Viva Rhett, Aristocrat. These have been very selective. All these companies we think have got good, strong balance sheets, and the valuations are quite solid. The way we've approached our valuations is continue to stick to our after-tax cash earnings yields, and we've said there's going to be a dip for at least 6 months, and then a slow build-up. So we'll be, earnings should be impacted for at least 2 years. We remain focused on our investment criteria. We have the puts have been exceptionally helpful. Vols have, well, the way you price these puts have gone through the roof. We've lightened our put options at extreme levels, and we now have got 3 or 4 times our money back on the puts, as well as still got a significant position that has gone so deep into the money that it's now like a future. Importantly, though, we also want to make sure we keep our heads up and we're remaining alert to new opportunities. So there's a couple of companies we've always wanted to own. We've selected 2. One of them is Rio Tinto. At these prices, we think it gives us, at this share price, and allowing for a 50% fall in the iron ore price, we think we can buy the iron ore business, which is 80 cents in the dollar, at a 10% after-tax cash earnings yield, which gives us quite a big margin of safety. Importantly, it has a rock-solid balance sheet with almost no debt, and in addition, we've just got a 4% fully franked dividend yield. Meridian is a very strong company that operates in New Zealand and generates electricity out of hydroelectric. Its hydroelectric power stations, has a very strong cash yield, and we've managed to buy that and started nibbling at that on a 7% after-tax cash earnings yield. Importantly, we think the portfolio is well positioned. We think there is extreme fear, and we're seeing some liquidity events as the markets sell off. We remain very liquid, so we still have approximately, depending how you calculate it, between 13 and 17 or 18% in cash. The reason for the difference is in the 13%, we don't count the put value, which is about 3 to 4% now, that if we liquidate it today, we could turn that into cash. So 13% without that, 17 or 18% with that. And remember, the put gives us good insurance. Today, we're seeing quite extreme sell-offs in particularly the smaller end of the market, where liquidity is at a premium. We're watching this carefully. We think we may add to a few, but we want to make sure that we use our bullets very, very wisely. Importantly, I think what you can take away from it is we're absolutely not panicking. We've kept ourselves psychologically sound by having the cash and having the puts and having high-quality companies. Our team is working well together. In a bizarre kind of way, Anton and I are feeling probably more excited about the value on offer than ever before. But we know there's a valley ahead, and it's going to be rocky. It's going to be testing our courage, but we think we're well positioned.